on the next steps to get that up as high as possible.
Absolutely. So let's talk a little bit about assets. Assets versus debt. What does that look like? We're going to move into, here in just a second, we'll talk a little bit more about debts, because I know that's a big question for a lot of first-time home buyers. Really, anybody probably under the age of 35 to 40 probably has some form of student loan debt. So that's going to be kind of a topic that we're going to talk about here in a little bit. But let's first talk about assets. So I'm going to come to you. I'm getting qualified for a loan, starting the process. You've run my credit score, 750 credit score, so I'm doing great. What assets can I use that will qualify and go towards my income, if you will, for that ratio that we're going to be talking about here in a little bit?
So the assets are referring to down payment, right?
Correct.
Okay, gotcha. So assets, great question. So what sources of money can we use for down payment to go towards down payment, right?
Yep.
Okay, so let's see here. You can get a gift from a family member that we are going to source. Don't deposit any money yet, but we're going to talk. I'm going to walk you through how specifically we get the money in your account. But you get to have that fun, awkward conversation with your great aunt or your grandma or something, or your parents, to get a gift from them to go towards closing costs. That's acceptable.
Okay.
There's no limit to that.
I have to pay that back, right?
You cannot pay it back. It's a gift. So it's not a loan. It's a gift. It's out of the graciousness of your parents or your grandparents. They're giving that to you. That's the one stipulation.
Can't pay it back.
Can't pay it back. So that's the first one. A lot of people don't know about that. Of course, you can use checking and savings, anything that's in your bank account. Biggest thing is main thing that you can't use is any cash money, like what we call mattress money. You can't really use that money. We can't see it within 60 days before closing. So if you have a bunch of cash, you're not going to jail. It's a conversation that we need to have to make sure I can get you on the right path to be able to use that.
Okay.
The most common one that I see right now is 401k loans and IRA loans. So you can actually take a loan against your retirement accounts, and don't know if you want me to go into detail.
Talk a little bit about that. Okay. I know I have some friends who are currently looking. They have Roth IRAs, they have 401ks set up. That's kind of where a lot of their savings are going right now. So
yeah.
I'm sure that's something that, that information-wise, they'd love to know. What does that look like? How can you structure that? How much of that can you use? Does that money have to be pulled out?
For sure. So everybody thinks, I know we've always learned through our parents and through society and media, like, don't touch your retirement. It's the worst thing you can do. I'm not advocating that you go and liquidate your retirement funds and pull your money out of the stock market to buy a house. Terrible idea. Don't do that. There's lots of tax penalties and capital gains and early withdrawals. We don't want to do that. What we're talking about is totally different. It's a loan against those accounts, completely separate from us. It's through your agency that manages those funds. So if your employer offers Fidelity or TD Ameritrade, whatever it might be, you're going to take a loan from that company. And it's not like a mortgage. It's super easy to do. It takes 5 days. You type in what you're buying it for, and they approve it within a couple of days. It's really easy to do. I always recommend to reach out to them to get the details of that. That's something that I can coach on a case-by-case basis. But essentially on there, what you can do is you can pull out typically up to about 50% of whatever you have in that account. And same thing with stock accounts. If you have a true brokerage account, I know you invest in the stock market as well.
Correct.
You can take out margin lien against that as well. So you take a loan out against that. And the great thing about it is it's such low interest on there. It's low risk because the actual company that manages those funds, they have the funds in their account. They have no risk.
Yeah, that money's not going anywhere. Yeah,
the market tanks. Let's just say hypothetically, the market tanks. They still have their money because it's 50%. It's good, right? So that's the benefit of that. A lot of people don't know of that. There's certain limitations and things like that. But for a lot of my first-time home buyers and second-time home buyers, we're able to use that as a solid vehicle to borrow that money.
Okay. Let's talk a little bit about assets. Now, a big question that a lot of first-time home buyers, it's going to be down payments. So 5% down, 20% down. Everybody I talk to, they want to put 20% down because that was the age-old, put 20% down when you're buying a house. That's the way it is. put 20% down.
Yeah, that's what our parents did, right?
Yeah, that's what they
didn't
did.
have an option.
Yeah, exactly.
So definitely don't have to put 20% down. I would probably say I'd even go as far as to say 50% of the buyers that I work with put 5% or less down. 50%, 5% or less. I'd say maybe 20% put 20. I'll say 25% put about 20% or more down. So a very small percentage of people are putting less than a quarter. People are putting 20% or more down. So it's because money is so cheap to borrow right now, and I'd much rather have, and a lot of financial advisors feel the same way if you talk to them, that they'd rather have you keep your money in the market to make you money and work harder for you versus having it tied up in such a low-cost mortgage on the house. So as far as how much do you need to get in the game to put down payment, it's ranging anywhere from 3% to 3.5% or 5% down for the minimum options.
Okay. And 0% for our veterans out there with
0% veterans, absolutely.
Yeah. All right, so let's